The largest silver market in the world just collapsed. Not suspended, not paused, collapsed. And the reason they're giving you is a lie. Between December and right now, China's only pure play silver investment vehicle, the UBS SDIC Silver Futures Fund, has been frozen more than 25 times. They are not letting people out. They are not letting people in. The doors are locked. And while the financial media is telling you this is about protecting investors from volatility, I have the premium data. I have the internal documents. And what they show is that Chinese investors were paying 100% premiums for silver exposure. They were paying the equivalent of $150 per ounce when the global spot price was $74. This was not panic selling. This was panic buying so extreme it shattered the system. And what I'm about to show you is not speculation. It's pattern recognition. This has happened 3 times in recorded history, and every single time it destroyed the empire that ignored it. Rome, 3rd century. The denarius contained 95% silver under Augustus. By the time Diocletian took power, it was less than 5%. They debased the currency to fund endless wars and a bloated government. Prices exploded. The military revolted. The empire fractured. Same pattern, same sequence, same outcome. Verified. The Dutch Empire, 17th century. After decades as the world's financial center, they made one fatal mistake. They fought 4 wars against England and France simultaneously while their currency was tied to physical silver reserves that were evaporating. By 1720, the guilder lost reserve status. Capital fled to London. The empire that had financed half the world couldn't finance itself. Same pattern, same sequence, same outcome. Check. The British Empire, 1945. 2 world wars drained the vaults. Britain owed more money than it had gold to back the pound. America owned the gold. America owned the productive capacity. Britain was forced to surrender reserve currency status in the Bretton Woods Agreement. Within 20 years, the pound collapsed, the empire dissolved, and British citizens watched their purchasing power evaporate in real time. Same pattern, same sequence, same outcome, verified. Now look at what's happening right now. The United States national debt is $36 trillion. The interest payments alone are now larger than the defense budget. On January 1st, 2026, China implemented export licensing restrictions on silver. Only 44 companies in the entire country are allowed to export it. Not a ban, a licensing system. But the effect is identical. Silver is trapped inside China's borders. They elevated it to the status of a strategic material on par with rare earth elements. They didn't announce it with fanfare. They didn't make headlines. They just quietly locked the exits. And 3 weeks later, the only fund that gives Chinese retail investors access to silver started suspending trading because premiums were, quote, unsustainable. But here's the part that exposes the entire lie. If premiums are too high, you create more supply. You issue new fund units at net asset value and sell them at the premium. That's how funds work. That's how arbitrage works. The premium collapses because supply meets demand. But they didn't do that. They couldn't do that because they couldn't source the underlying silver to back those new units. So instead of creating supply, they locked the doors. Let me walk you through the exact timeline because when you see the sequence, you cannot unsee it. Early December 2025, the fund starts issuing unprecedented risk warnings. The premium over net asset value hits 12%. The fund manager is essentially begging investors to stop buying, but they don't stop. They accelerate. December 26th, Class C subscriptions are closed entirely. The premium is now over 60% above net asset value. Think about what that means. The fund is supposed to track silver futures. But Chinese investors are so desperate for exposure that they're paying 60% more than the fund's actual holdings are worth. This is not rational speculation. This is fear. January 22nd, 2026. First full-day suspension. The official reason is that premiums are unsustainable. But nobody in the financial media is asking the obvious question. If the premium is too high, why not arbitrage it away? Why not create more units and sell them? The answer is sitting in Shanghai Futures Exchange data. Physical silver inventories hit a 10-year low on December 2nd, 2025. The warehouse is empty. January 28th, all subscriptions suspended. Not just Class C, all of them. The premium over Shanghai Futures is now 36%. And here's where it gets really interesting. This is the same day that global silver prices are crashing from $120 down into the 70s. The paper market is collapsing. But in China, investors are still paying massive premiums just to get in. February 2nd, 2026, the nuclear option. UBS SDIC announces they're changing the fund's valuation model. Instead of using Shanghai Futures exchange prices, they're switching to major international silver futures markets. Translation? They're going to start using COMEX prices instead of Chinese prices. The result is the largest single-day net asset value collapse in Chinese public fund history, 31.5% in one day. But buried in that announcement is the smoking gun. Before the valuation change, the premium over net asset value had exceeded 100%. Chinese investors were paying more than double what the fund's holdings were worth based on Shanghai prices. After they forced the revaluation to international prices, the fund's net asset value crashed because the international price was half of what Shanghai was implying. February 3rd. Trading resumes briefly. The fund immediately hits limit down. Negative 10% circuit breaker, it locks limit down. And even after the massive net asset value reset, the premium is still 52.3%. Investors are still trying to buy. February 5th to 6th, suspended from market open until 10:30 a.m. 4 consecutive limit down days. More than 25 suspensions in less than 2 months. Now let me explain what this premium data actually proves. A 36% premium means that if silver futures on Shanghai are trading at $100, the fund is trading at $136. Investors are paying 36% more than the underlying asset is worth just to get exposure. In normal markets, premiums above 5 to 10% get arbitraged away almost instantly. But this premium didn't collapse. It went to 60%, then over 100%. By early February, Chinese investors were paying the equivalent of $150 per ounce for silver exposure when the international spot price was $75. This is not speculation. This is desperation. This is people who understand that physical silver is running out and are willing to pay anything to secure exposure before the doors close completely. And the fund couldn't meet this demand because they couldn't source the underlying silver. So instead of arbitraging the premium away, they suspended trading. The official explanation is that regulators are protecting investors from excessive premiums and speculative risks. But that explanation is mathematically incoherent. If you want to protect investors from paying too much, you increase supply. You create new units at net asset value. The premium collapses. Everyone wins. But they didn't do that. They locked the doors instead. And the only reason you lock the doors is because the vault is empty. This is not about protecting investors. This is about preventing a run on metal that doesn't exist. And when they forced the valuation reset to international prices, they exposed the fracture. The Shanghai silver price was trading 30 to 45% above Western prices. In a functioning global market, arbitrage closes that gap immediately. You buy silver in New York at $74, ship it to Shanghai, sell it at $110 or $120, you make a fortune. The gap closes, but it didn't close. The gap persisted. The gap widened. And that tells you the metal is stuck. It cannot move freely from west to east. And the reason it can't move is sitting in that regulatory announcement from December 30th, 2025. China locked the exits. Only 44 companies are permitted to export silver from China over the 2026 to 2027 period. 44 licensed entities. Everyone else is locked out. They elevated silver from an ordinary commodity to a strategic material. They didn't make a big announcement. They just quietly implemented export restrictions that effectively trap silver inside China's borders. Now think about the sequence. January 1st, export licensing takes effect. January 22nd, the silver fund starts suspending trading because premiums are unsustainable. January 28th, all subscriptions closed. February 2nd, forced valuation reset causes 31.5% net asset value collapse. They locked the metal inside China with export restrictions. Then they locked Chinese investors out of the fund because they couldn't source enough metal to meet demand. The doors are closing on both sides. And here's the detail that proves this was coordinated. In late January 2026, just days before the crash began, Chinese billionaire trader Beyond placed a massive short bet on silver, $300 million short. This is the same trader who made a fortune calling gold's record rally. He knows how these markets work. He knows how Chinese regulations work. And he placed a $300 million bet that silver would crash right before the fund suspensions began. He knew the doors were closing. He knew the system was about to break, and he positioned accordingly. That is not luck. That is information. Mathematical certainty. Now let me show you what a fractured global commodity market looks like, because this is the part you cannot ignore. Western price, COMEX in London, approximately $74 to $79 per ounce. China price, implied through fund premiums and Shanghai futures, approximately $110 to $150 per ounce, depending on which metric you use. The arbitrage gap is 45.8%, according to Shanghai premium data. In dollar terms, that's a $76 per ounce difference between buying silver in New York and selling exposure in Shanghai. This gap should not exist. Arbitrage should close it. Traders buy silver where it's cheap, sell where it's expensive, prices converge. That's how global markets are supposed to function. But it's not working. The gap is not closing. The Shanghai premium after the February crash hit plus 29%. It's now at plus 45.8%. It's widening, not narrowing. Why isn't arbitrage working? 3 reasons, and all 3 point to the same conclusion. First, China's export licensing restrictions severely limit inbound silver flows. You cannot just ship container loads of silver into China and sell it anymore. You need licenses. You need approvals. The metal is being throttled at the border. Second, physical silver simply is not available in sufficient quantities. Western vaults are being drained. COMEX registered inventories are at multi-year lows. There's not enough loose metal to arbitrage a 45% gap. Third, fund managers couldn't create new units even if they wanted to because they couldn't source the underlying silver. The physical market is so tight that a fund managing a few $100 million worth of silver exposure couldn't get delivery. Not opinion, pattern recognition. This is what a shortage looks like. Now pause for a second and think about what the financial media is telling you. They're saying silver crashed because of a bear market. They're saying the rally was speculation and it's over. They're predicting $50 silver. But in China, people are paying $150 equivalent just to get in. The fund is shutting down to stop them. Does this look like a bear market to you? In every bear market in history, prices fall because nobody wants the asset. Premiums collapse, demand evaporates. The market self-corrects. But that is not what's happening here. Prices are falling in the West, while investors in the East are bidding up closed-end funds to double their net asset value. Regulators are having to lock the doors to prevent a buying frenzy. If this is a bear market, it is the strangest bear market in the history of commodity trading. Or it's not a bear market at all. It's paper manipulation being exposed by physical demand that cannot be met. Let me show you the inventory situation, because this is where the shortage becomes undeniable. Shanghai silver inventories hit a 10-year low in December 2025. Specifically, on December 2nd, physical silver inventories on the Shanghai Futures Exchange plunged to the lowest level in over a decade. This is not a temporary drawdown. This is structural depletion. At the same time, COMEX registered inventories, the metal available for immediate delivery against futures contracts, have been drained at an unprecedented rate. Between early and mid-January 2026, in just 7 days, 33.45 million ounces of silver were physically withdrawn from COMEX vaults. That's 26% of registered inventory removed in 1 week. Combine the Shanghai depletion with the COMEX drain, and you have both ends of the global silver market running dry simultaneously. The East doesn't have metal, the West is bleeding metal, and the arbitrage that's supposed to balance the system isn't working because the metal can't flow freely. This is not a crash, this is a fracture. The market is split into 2 pieces, West and East, with a $76 price gap between them that cannot close because the physical metal is trapped. Now let me bring this all together because the implications are staggering. The global silver price is fake. Or more precisely, the global paper price is increasingly disconnected from regional physical realities. COMEX can print contracts all day long, but if Chinese buyers can't access COMEX delivery and Shanghai inventories are at decade lows, and export restrictions prevent metal from moving, then the COMEX price is just a number on a screen. It's not reflecting physical supply and demand. It's reflecting paper liquidation and margin calls. The regional price is real. The $150 equivalent that Chinese investors were paying, that's closer to the true physical price in a market where supply is constrained and borders are closing. That's what silver costs when you can't just call up a dealer and get delivery in 2 weeks. That's what it costs when the warehouse is empty and the exits are locked. Here's what they did. First, China locked the exits with export licensing on January 1st. Only 44 companies can ship silver out of China. Then they locked the entrances by suspending the only fund that gives retail investors access to silver. Chinese citizens cannot easily buy physical silver. They cannot freely invest in silver funds. They're being systematically cut off from the market. Why would a government do this unless they expect severe shortages? Why would you trap metal inside your borders and prevent your citizens from accessing it unless you need that metal for strategic purposes? Industrial production, national reserves, economic security. The pattern is clear. China is hoarding silver. They're restricting exports. They're limiting financial access. They're preparing for a world where silver is scarce and strategically critical. And they're doing it while the Western paper price crashes, giving them cover to accumulate at lower prices before the physical shortage becomes undeniable. This is not happening in isolation. This is part of a coordinated global shift in how commodities are being controlled and allocated. The United States government just announced Project Vault, a $12 billion critical mineral stockpile, announced at the exact bottom of the crash. $5 billion is migrating from paper gold ETFs into tokenized blockchain verified physical gold. Every major player is moving to secure physical resources. The US government is building strategic stockpiles. Chinese regulators are locking metal inside their borders. Institutional investors are abandoning paper claims for cryptographically verified physical allocation. And retail investors who trust the paper price are being systematically shaken out through volatility and fear campaigns. This is the great bifurcation, the separation of paper and physical, the end of the unified global commodity market where arbitrage kept prices aligned. We are entering an era of regional silos, export restrictions, strategic hoarding, and massive price differentials that cannot be closed because the metal cannot flow. Silver is ground zero because it's the most critical industrial metal that's also a monetary asset. You need silver for solar panels, electric vehicles, 5G infrastructure, AI data centers, weapon systems, medical equipment. It's irreplaceable in high-tech applications. And it's also the oldest form of money, the inflation hedge, the safe haven asset that's been valued for 5,000 years. When you combine industrial demand that's growing at 5 to 8% annually with investment demand that's exploding, because people don't trust fiat currencies anymore, you get a structural deficit. The world uses more silver every year than it mines. That deficit has to be filled from above-ground stocks. But what happens when governments and institutions decide they want to hold those above-ground stocks instead of selling them? You get Shanghai inventories at 10-year lows. You get COMEX losing 33 million ounces in 7 days. You get Chinese export restrictions, limiting outflows to 44 licensed entities. You get fund suspensions because there's no metal to back new units. You get 100% premiums because buyers understand the shortage is real and they're willing to pay anything to secure exposure before it's too late. We are not at the cliff. We have already walked off it. The only question now is whether you understand that before you hit the ground. The London Bullion Market Association, the global hub for physical precious metals trading, is experiencing its own stress. Inventories declining, lease rates spiking, backwardation in futures markets where spot prices trade higher than future prices, signaling immediate demand outstripping supply. When you have Shanghai at decade-low inventories, COMEX bleeding registered stocks, and London showing signs of stress, you have all three major silver trading hubs experiencing supply constraints simultaneously. This is not a local issue. This is not a Chinese anomaly. This is a global system under pressure. And the 45.8% Shanghai premium is the canary in the coal mine. It's telling you that in at least one major market, the physical reality has completely divorced from the paper price. And if it can happen in Shanghai, it can happen in London, it can happen in New York. It can happen anywhere that physical demand overwhelms the paper contracts that claim to represent that physical metal. What happens when the March COMEX delivery period arrives? Projected demand is 70 to 80 million ounces against registered inventory of 95 to 107 million ounces. If even half of that demand stands for delivery, if contract holders say we want the metal not cash settlement, COMEX will be strained to an unprecedented degree. Do they deliver? Do they force cash settlements? Do they change the rules mid-game like they did with nickel on the London Metal Exchange in 2022 when the short squeeze broke the market? Any of those outcomes would further erode confidence in paper markets and accelerate the migration to physical and tokenized alternatives. And here's what should terrify you. What happens if China decides to dump their U.S. Treasury holdings and buy physical commodities instead? They hold over $800 billion in U.S. government debt. If they decide that in a world of fracturing trade relationships and potential sanctions, holding dollar-denominated paper is riskier than holding strategic physical resources, they could trigger a commodity buying spree that would overwhelm global markets. We're already seeing signals of this. The export restrictions on silver are part of a broader pattern that includes rare earths, tungsten, antimony, gallium. China is systematically restricting exports of materials that are critical to Western industries and defense. They're building leverage, they're creating dependencies, and they're hoarding the physical materials while the West trades paper contracts. The UBS SDIC fund suspension is a symptom of this larger shift. This isn't about protecting investors from high premiums. It's about stopping money from fleeing into hard assets the government can't easily control. Officials talk about volatility, but the data tells another story. 10-year low inventories, massive arbitrage gaps, and premiums hitting 100%. That isn't hype, that's scarcity. Look at the timeline. In early December, the fund issued risk warnings at just a 12% premium. Weeks later, premiums hit 60% and subscriptions were restricted. By January, premiums doubled and trading was suspended. If this were speculation, managers would have let it burn out. Speculative bubbles collapse on their own. Instead, pressure intensified. Closures followed, then suspensions, then forced resets. That's not how you manage hype. That's how you manage a run. Investors weren't chasing profits. They were chasing metal the fund couldn't secure. Meanwhile, citizens were locked out while exports tightened and strategic reserves grew. The message said, silver is risky, but policy screamed, silver is critical. Actions always reveal the truth. And when governments restrict access to commodities, it's not because they're worthless, it's because they're scarce. Paper prices don't matter in shortages. physical does. And once supply dries up, the gap snaps shut fast. That's when markets fracture. And only real metal counts.